Hi, this is Matthew Cratter from Trader University. And today we're going to talk about the most dangerous dividend stock that's out there. Now, if you've lost money holding General Electric the last few years, you're definitely going to want to pay attention to this video. General Electric was considered a very safe blue chip stock. And you can see even in the current bull market, it's gone from above 30 now to below 14 in just less than a year. So the other most dangerous stock out there that I think could do something like General Electric is a stock that many of you probably own. In fact, I used to own it until fairly recently. It's called ExxonMobil. XOM is the ticker. And you can see if you just look at the surface, it looks like a great stock. It's an oil producer, and it pays a very good dividend right now. It pays 4.2%, which in this environment is just fantastic. But when you dig in and look a little closer, there's some disturbing things, which I'm going to show you in this video. So let's go to Morningstar. We click on Financials, and then we'll click on Income Statement. And if you look here for the revenue, each of these columns is 1 year. You can see the annual revenues for ExxonMobil have been falling since 2013. So they used to be 420 billion. This is actually down to 237. And this is not what you want to see. If you see shrinking revenues in a company, that's a very bad sign. And the reason for this is Exxon's been having a lot of trouble finding new oil reserves. It's become very expensive to replace the oil that they currently own and are pumping. So let's look at the cash that Exxon has returned to shareholders. So if we go to the cash flow statement, we're just on Morningstar, Financials, and let's see, cash flow. We're on the cash flow statement. Yep, perfect. If we scroll down, you'll see here, you can see the dividends, cash dividends paid over the last 5 years right here. And then we'll also look at repurchases of stock, so they're buying back their stock. And if you add these numbers up, you'll find that Exxon has paid about $60 billion in dividends over the last 5 years. And they bought back about $35 billion worth of stock. Now, that adds up to $95 billion, which seems great. They're returning cash to shareholders. The only problem with this is that if we look at the actual money they've earned, so dividends are paid out of, they're not really paid out of earnings, they're paid out of free cash flow, which is what's left, which is the actual cash that the company is putting in their pockets. Free cash flow is basically operating cash flow minus CapEx. And CapEx in this case is what they're spending to find new oil. So you can see down here, here's the free cash flow for Exxon for the last few years. And it is, if you add these numbers up, you'll find their free cash flow has been about $48 billion. Now they've paid $60 billion in dividends and they've returned $35 billion through stock buybacks. So in other words, they have not been making enough money in their business to even pay the dividend, much less buy back stock. It's about, twice, they've been spending about twice as much as they've been making in free cash flow. Now, this is a very bad sign. It's obviously not sustainable. You can't keep paying out money if you're not earning it. And that's why it's important to look at free cash flow when evaluating the safety of a dividend, because this is the actual thing that they're paying dividends out of. Now, how is Exxon been able to do this? Well, if we look at their balance sheet, again, we go to Morningstar, Financials, and then look at their balance sheet. And we scroll down and look at long-term debt, which is right here, long-term debt. You can see in 2013, their long-term debt was about $6.5 billion. Today, it's at $23 billion. Just last year it was at 27. So they've massively increased their amount of long-term debt. So basically what they've been doing is they've been borrowing money and then returning that to the shareholder. And in the process, really levering up the company. This makes it a very dangerous bet. So obviously this is not investment advice. I can tell you that I've sold my ExxonMobil when I figured this out. It seems like a blue chip, seems very safe, pays us good dividend, but this is not something I would hold long term. You can obviously trade it for a couple days or something, but it's long-term core dividend holding. This is extremely dangerous stock. It's basically a self-liquidating company. They're borrowing money to pay the dividend. The revenues are shrinking, and it's become a shadow of its former self. Please subscribe to my YouTube channel And if you have any questions or comments, please leave them in the comments below. And if you want to check out my books on Amazon, there'll also be a link in the notes below, my book on Warren Buffett. Thanks for listening, and I'll see you in the next video.